And today I'm going to be talking about the question that we all have. Well, if I can get this to go. And has the dollar rally run its course? The dollar's been moving up basically since 2009, but the rally has stalled recently, and everybody's wondering: has it peaked? Particularly over the last month, it hasn't done very well. It's fallen against almost all the major currencies, and particularly poorly against the emerging market currencies, which are in yellow in this graph. Some of the major exporters, such as Korea and Taiwan, have seen their currencies rally. This really indicates a renewed confidence in global growth, I think, which is causing some movement back into emerging markets at the cost of the dollar. The safe haven value of the dollar is receding. In fact, the broadest measure of the dollar's value, the Fed's broad trade-weighted index, shown here in the yellow line, peaked on January 20th, and it's been slipping ever since, although just recently it bottomed on March 18th. Question then, as I say, has the dollar peaked, or is this just a temporary retracement? Have we seen the bottom for euro dollar, for example, and the best for the dollar overall? Personally, I don't think so. I think this is just a breather in the dollar rally. The reason the dollar is weak for now has to do with what's called the dollar smile. The data aren't good enough to cause people to buy dollars, but nor are conditions in the rest of the world bad enough to cause them to sell other currencies and move out of other currencies into dollars. So the dollar basically drifts lower. This is called the dollar smile. Then, okay, so what could cause the market to shift? Why do I think the market is going to shift? Why do I think people will start buying dollars on the one hand, or why do I think people will start selling the emerging market currencies and other currencies, bailing out of these currencies and to move into dollars? Well, today I'm going to focus on why people will want to buy dollars, not why people will want to sell other currencies. Although the two are obviously two sides of the same coin, there are different reasons. Now, the main thing I think that is moving demand for dollars, and one of the main reasons that demand for dollars has fallen recently, is expectations of Fed policy. Since the middle of last year, in fact, one of the main things that's moving dollar has been the anticipated pace of tightening in the U.S. Now, this graph is a little complicated. The yellow shuts line here shows the change in the last 3 months of how much people expect the Fed funds rate to rise over the period starting a year from now for 1 year. So it's the expected rise in Fed funds rate over 1 year starting a year from now, the forward rate, as it were. The blue line is the change in euro dollar over that period. As you can see, since the middle of last year, there's been a pretty good correlation between these two. I think this represents the assumption that the Fed is really where the action is. That's to say, the market assumed the ECB was largely at the zero bound, and even if it did cut rates, it didn't have that much more room to move them into negative territory. So the main action would be the Fed, which of course has unlimited room to hike rates. So that's where the main action would come from. And the Fed has indeed been talking about for some time about starting to raise rates. And it did start to raise rates in December, as we all know. So one of the main things moving the euro dollar has been the expected pace of tightening in the U.S. As people pushed back the pace at which they expect the Fed to tighten, the dollar fell with it. Furthermore, just Tuesday, Fed Chair Yellen basically said that she agreed with the market's moves and more or less thanked the market for pushing down rate expectations. The key was when she was explaining why at the last FOMC meeting the committee could leave its growth and inflation forecast more or less unchanged, but cut their interest rate forecast for the year in half. So whereas before they expected 4 rate hikes in 2016, now they only expect 2. She noted there had been some adverse moves in stocks and commodity prices, but explained that investors responded to those developments by cutting their forecast for Fed funds and thereby putting downward pressure on long-term interest rates as well. That cushioned the impact of the turmoil on the real economy. I thought this was a little strange for her to say. It's basically the same as saying, thank you for saving the world from us, which, yeah, I think they could have done this themselves. So, but against this kind of a background where the Fed is welcoming market moves away from its own forecast, I think it's possible for the dollar to weaken further in the near term. But let's not get carried away. The fact is, the FOMC members are still forecasting 2 rate hikes this year, while the market's only pricing in a 59% chance of even 1 hike. You can see here the difference between the FOMC forecast for the path of interest rates, the yellow line, and the market's forecast, the blue line. There's still a big gap, a huge gap between what the FOMC says and what the market thinks. That leaves a lot of room for the market to change its mind. Now, what might get the Fed to hike rates? What would be necessary for this to, for them to actually carry through with this rate hike? Well, I think the main thing would be perhaps a hike in oil rates. Well, let me step back a second. Yellen's speech was quite noticeable for its focus on issues outside of the U.S. The word global appeared 10 times in the 14-page text, and the phrase global financial and economic developments appeared 3 times. In fact, most of the time she mentioned risks to the FOMC. Most of the time that she mentioned risks to the FOMC scenario, it had to do with global events, not just domestic events. In other words, it looks to me like she's acting like the chairman of the world central bank, not just the U.S. central bank. So something globally has to happen for her to feel comfortable moving, something that affects the entire world and the global outlook. And that thing, I think, is oil prices stabilizing. Oil is the most important variable right now because of its link to banks through non-performing loans, to the credit market from oil companies that have borrowed a lot of money, and to investment, because a lot of the investment that goes on, at least in the United States, is done by oil companies. If oil can stabilize in the $30 to $40 range and not make new lows, I think that would be a huge boost to the U.S. economy and to the global economy. This would be low enough to provide a shot in the arm to consumers in all the industrial economies and to much of the developing world too, but it would still be high enough to avoid a collapse in the oil industry. So it would be sort of a Goldilocks scenario versus oil, with regards to oil. Now, I think this is likely to happen. We've seen a huge restructuring in the U.S. oil industry. The number of oil rigs in use, which is the yellow line in the graph, has fallen dramatically. It's fallen at a peak. It was around 1,600 oil rigs in use in the U.S. to just 372 rigs now. Now, the strange thing is that hasn't yet led to a decrease in oil production, in part because they're shutting down less productive wells, in part because they're actually able to drill more from each well than they were before because of technological improvements. But historically, the output of oil has followed the number of rigs, and I think it should follow it to some degree in the near future. As this graph here shows, U.S. oil production has basically followed the number of rigs with about an 18-month lag. And so we should pretty soon start to see U.S. oil production turn down, although maybe not as much as we would have in the past as the technology improves. So in any event, I think U.S. oil production may fall, and that should be enough at least to stabilize prices, to get them just trading in a range, which, as I said, I think would be the best of all possible worlds for the central banks. The other thing that Yellen talked about was bouts of turbulence in the financial markets. That too is starting to change. This graph shows a variety of measures of volatility in various markets. The VIX index, which is a measure of the expected volatility in the U.S. stock market, and similar readings with similar measures for the bond market, for the U.S. Treasury market, for the G7 FX, and for oil. As you can see, the expected volatility of all of them has come down substantially since earlier in the year. This shows much calmer markets, and in fact, the stock markets and the bond markets are back to about normal. Fortunately for us, the only one in the market where volatility seems to be turning back up is the foreign exchange market. So that provides us with a lot of opportunities. Similarly, we've got here the Bank of America Merrill Lynch Global Financial Stress Index. This is a cross-market measure of risk, of hedging demand, and investor flows in the global financial system. So it's a way of measuring what kind of turbulence and stress there is around the world in all financial markets. Now this is back below where it was in December when they hiked rates. So although it's still not back to the average, it's moving in that direction, and that should help to calm Ms. Yellen's nerves. Yellen specifically mentioned growth in China as a major determinant of global growth and of financial turbulence as well. This seems to be stabilizing now. On the left-hand graph, we've got the Bloomberg monthly estimate of China GDP. That seems to have bottomed for now. And the forecasts that they've come out with at the recent People's Congress have been not that much of a decline in growth for this year. So we know what the target is going to be for the rest of the year. They are going to aim, they are working to prevent a hard landing there. Meanwhile, on the right-hand side, you can see that the Chinese stock market, the blue line in that graph, has stabilized, is moving up a little bit. And the renminbi, the yellow line there, has also strengthened, which should lessen financial pressures elsewhere. So this should really, the China situation shows a lot less pressure on global financial markets. So I think the global financial and economic developments that had Chair Yellen so worried are likely to be calmer in the coming several months. So what about the domestic situation? What about the U.S.? It looks like things are getting better there as well. The U.S. Economic Surprise Index, the blue line in this graph, has been moving up, and it's now about zero, meaning that the U.S. economic indicators are largely coming in as the market expects. They're no longer disappointing economists and the markets. Now, if expectations don't change, then the next step would be naturally for them to start coming in better than expected. Yellen also mentioned a whole list of indicators that are going well, such as consumer spending, income gains, the housing market, and of course the labor market. She did, though, mention 2 points with regards to inflation that bear watching. And this is really what we've got to be looking out for now, more than just the non-farm payrolls number, in my view. First off, she said that while the core personal consumption expenditure deflator is near their 2% target, it's too early to tell if it will stay there. This is something we've heard from several of the FOMC members recently. Secondly, she and other, I think, Chicago Fed President Emmons just yesterday expressed his concerns on the same matter. There are signs that inflation expectations may have drifted down. They don't want inflation expectations to get unanchored. Now, it's certainly true that the personal consumption expenditure deflator might not stay where it is, because a lot of personal consumptions have to do with services, not necessarily goods. And the price of services is largely determined by wages. And this is where we come down to this the circle there are few signs of upward pressure on wages. In this graph, you've got the core PCE deflator, which is the Fed's targeted inflation measure in yellow. And then we've got two measures of wage pressures here, average hourly earnings and the employment cost index, which is a broader measure. Neither of them is showing any real acceleration from these rather low levels. So there's with no signs that wages are headed higher, it's not really clear that prices of goods or services are likely to be headed higher anytime soon either. Of course, there is some argument among economists, which is the chicken and which is the egg. Do higher wages cause companies to raise their prices, or do higher prices cause workers to demand higher wages? It's not really clear which way it goes. So it could work. It could work either way. Now, as for inflation expectations, it's true that survey measures of inflation expectations are falling. That's what we've got on the graph on the left-hand side. The blue line is the Conference Board survey. The yellow line is the University of Michigan survey. And as you can see recently, the survey measures of expected inflation have been declining. But the market measures which is on the graph on the right, have started to turn up recently. So it looks like the markets are more optimistic about the Fed's chances of hitting its target than the people they survey. And frankly speaking, people tend to be much less aware of things. They basically look at the gasoline price and judge just from whether gasoline prices are going up or down. So I think the survey prices are showing that inflation expectations aren't really falling that much, and I think the markets are much more optimistic about the Fed's hitting its target, and therefore I'm optimistic too. Now, my personal view is the markets are likely to calm down, the oil price will stabilize, China growth probably won't start accelerating, but it's not likely to collapse anytime soon either, and therefore the Fed can move along the path that it's laid out. Remember, I showed this graph to you earlier. The FOMC members are still forecasting 2 rate hikes this year, while the market's only forecasting in a 59% chance of even 1 hike. So there's still a big gap between what the FOMC says and what the market thinks. For example, just yesterday, Chicago Fed President Evans, who is a noted dove, expressed his concerns about inflation expectations, as I just mentioned, and said that, quote, a very shallow path, such as the one envisioned by the median FOMC participant in March, is the most appropriate path for policy normalization over the next 3 years, unquote. In other words, even the doves on the committee think 2 rate hikes this year is the kind of cautious approach that Yellen was talking about. This is not what the market's looking for at all. So I think if the conditions continue as they are, the Fed will surprise the markets by hiking rates twice this year, as they've said they'll do. This is why I don't think the dollar's bottomed yet. Or I'm sorry, I don't think the dollar's peaked yet, pardon me. Now the question is, if they are planning on raising rates, when might they do it? Or when would be an appropriate time to do it? After Yellen's speech, there's almost no chance that they move in April. The meeting after that is on June 15th. We'll have 3 more non-farm payroll readings by then. If they get 3 non-farm payrolls that are above 200,000, and the PCE deflator at least stays where it is at 1.7%, they'd really have a hard time explaining why they won't move. They keep saying they're data dependent, but if the data comes in the way they want it to, they really have to show that they're following the data. Now, the problem with June, though, is it's only 8 days before the Brexit vote in the UK. They might feel that the Brexit vote is enough of a global systemic risk that they don't want to upset things further ahead of that. I don't know. It depends, I think, a lot on what the polls are going to be saying around that time. Now, after that, the next meeting is July 27th. 4 non-farm payrolls will have come and gone by then, together with a lot of inflation data. I think they'd be quite likely to hike then if they haven't done so by June. Now, if they do let it go in July, then they'll have to fit 2 rate hikes into the second half of the year in order to fulfill their forecast. That could be difficult, seeing as there's a U.S. election in November. However, in the past, the Fed has raised rates ahead of U.S. presidential elections. In 1980, for example, when the U.S. was suffering from runaway inflation, the Fed raised rates for 4 months in a row ahead of the election. They nearly doubled the Fed funds rate from 9.5% to 18%. They also raised rates in July, August of 1984, May, June, July, August, and November of 1988, and June, August, September, and November of 2004. So while the market may think the presidential elections is a constraint, it hasn't been one in the past. They can still raise rates twice in the second half of the year. For now, but of course, that means that any rate hike would be put off until the second half. Rate hike would be put off until the second half of the year. And as we've seen, expectations for Fed moves are what's been causing the currency to move, what's been causing the dollar to move. So that would suggest that the dollar does have more room to decline over the next several months until speculation starts heating up about about a rate hike. And I think with the aftershocks of Yellen's speech still out there, and the time for this time frame for Fed, for any time frame being pushed out, the dollar can still weaken further. What might be the way to play this? Well, I think emerging market currencies are likely to benefit from expectations that the Fed will delay hiking. In this graph, we see the movement of the dollar against the commodity currencies in yellow, the emerging market currencies, the tradable ones, the ones that retail investors can actually trade, in gray, and the G10 currencies, excluding the commodity currencies, in blue here. You can see that the emerging market currencies saw a big sell-off, but recently have been rallying. Or looked at the other way, the dollar gained a lot against the emerging market currencies, but recently have been falling. This is quite reasonable. The reason is that over the last several years, many companies in emerging market countries borrowed money in dollars to take advantage of the low interest rates in dollars. Now that the dollar is rising and U.S. interest rates are rising, this was a double whammy to these countries, to the companies, and therefore also to the countries. And a reason why emerging market currencies were weakening. Companies in these countries had to bail out of, had to quickly rush to buy dollars and refund their loans, unless they had to do it with a weaker currency in the future. But now, with the dollar a bit softer and U.S. interest rates not expected to rise as quickly, these companies, and therefore their countries, get some breathing space. This is likely to help the currencies. And with this, money has been flowing back into the money that flowed out of the emerging market countries has been flowing back into them. This graph, for example, shows the foreign inflows into Asian stock markets. And you can see how it's a lot of money flowed out in the second half of the year, but it's started to flow back in over the last few weeks. This will no doubt help these currencies to recover further. I think for similar reasons, the commodity currencies are likely to be beneficiaries of this kind of risk-on feeling too. Here, for example, dollar CAD on the left-hand side, you see it hit a low for the year yesterday. Even though oil prices continue to move lower. And yesterday, the Australian dollar was rallying too, even though iron ore prices have started to turn down again. To me, this is a signal that markets are bullish on these currencies, that perhaps they feel they're oversold and are going to buy them no matter what, at least for the time being. So how far can the retracement of the dollar go? This graph shows the position of speculators, the net position of speculators on the derived from the Commitment of Traders report that comes out every Friday. The yellow line shows the net position of speculators in all currencies. Pardon me. The blue line shows the net position in the DXY index, which is the dollar. And it's reversed so that when people are long dollars, it's on top of the line. When they're short dollars, it's below the line. I'm sorry, short dollars is above the line, long dollars is below the line. It shows that investors have cut their long dollar positions significantly recently by about half, but they're still net short currencies and long dollars. So there is still more unwinding to go. They're about halfway through the unwinding of these positions. However, I don't think they'll. I think investors might want to go to a neutral position, but still, as we know, as the Fed is the only game in town, and they're the only central bank likely to hike rates at any point in the foreseeable future. So I personally don't think people will want to go short dollars. They may be covering their positions, but I don't think they'll want to be short dollars or use dollars as a funding currency, for example. Interest rates are just too high relative to other countries' currencies where you can use to fund. So I think the dollar decline does have further to go, but I don't think the rally, in the long-term rally, is over. This graph shows the movement of the dollar against the euro since 1973, using the Deutschmark to figure out what it would be before the euro came into being. And it's divided up into various periods when the dollar was trending. The blue line shows when the dollar is going in the direction of the trend, and the yellow parts are when it is experiencing a counter trend. And you can see that the dollar does have very long-term trends, but within these trends there are frequently reversals that can be quite substantial and quite long. The dollar can reverse its gains, lose a lot of its gains or losses, and yet still the long-term trend is intact. I think so. The long-term dollar cycle is always punctuated by periods of counter-trend moves. This counter-trend move, to me, is nothing new. I'm still confident that the dollar is headed higher in the long term, even though we may be in a counter-trend for several more months. And so that's my view on the dollar. And with that, I'd like to throw it open to questions. Let's get the chat line. Okay, has the dollar peaked? I would expect, and it's a question about the non-farm payrolls. The market's expecting a non-farm payrolls about 195. The ADP report, which is not a perfect forecaster of the initial estimate of the non-farm payrolls, but it's the best we have, also came in at 200,000. I would expect a non-farm payrolls around 200,000, and that I think it will cause a bit of a reversal. I think it's quite possible that it would cause a little bit of short covering or profit taking on dollar shorts, and I would expect the dollar to rally somewhat on Friday after the number comes out. It's my research has shown, I believe, actually the most volatile currency, the currency that sees the biggest increase in volatility with the non-farm payrolls, is dollar yen. So if you're interested in taking a position ahead of that, you might want to use dollar yen. I personally don't urge anybody to take a position on these indicators. There are lots of firms on Wall Street. They have a lot of people with PhDs in economics, PhDs in mathematics, PhDs in mathematical economics. And there's a lot of money riding on forecasting these indicators, and they can't do it. They can't do it reliably. So if they can't do it, I'm sorry to say, I don't think you can do it either. I know I can't do it. you can have a flutter if you want, but please look at it as a bet, not as an investment. Yeah. Yes. Any other questions? Right. Well, if you'd like to hear more about my Okay, we'll keep it open for 5 more minutes just in case there are in case there are any more questions. Yes, we are a broker. But we are not taking the other side of the trade, so there's no conflict of interest there. We're a broker, not a market maker. No, we're located. Well, I'm located, and a lot of our sales forces and personnel is here in Cyprus. We've got operation, and our CEO and some of our other staff are in the United States. So we're a truly global organization. Okay, well, if you'd like to hear more about my views on the markets, simply open up an account with FX Primus, and you'll get access to my daily insights, videos, forex glossaries, and a lot more. So, thank you very much. It's fxprimus.com. Thank you very much for attending the seminar. This is Marshall Giller, head of investment research at FX Primus. Wishing you all the best from FX Primus, safest place to trade.